In this video, we're going to talk about how to account for loss contingencies. So let's say you work for a firm and you're preparing the financial statements at the end of the year, and you notice that there's this really looming pending lawsuit that you're worried about. It looks like the firm might have to pay somewhere in the neighborhood of $65 million. Now, if you don't disclose this, if this doesn't go to the financial statements, do you think that that's something that might be information that would change the decision of an investor or a bondholder about whether to invest or lend money to your firm? Of course, right? Of course this is important information. So then now we've got this issue, though, of, well, do we recognize it in the financial statements? Because it hasn't actually occurred, right? The $65 million that you think that the firm might have to pay, or maybe it's $100 million, whatever, that's just a guess, right? You don't really know that. Or do you? Maybe you have an attorney telling you, look, we know that somewhere in the neighborhood of 65 to 85 million, it's almost guaranteed that we will owe that we're going to lose this lawsuit. So you've kind of got all this uncertainty regarding this contingent event, and you really don't know what's going to happen. So you're trying to decide, well, do we recognize this in the financial statements? Do we just make a disclosure but not actually recognize the loss? How do we handle that? So that kind of gets into the accounting for loss contingencies. And the rules are pretty simple, but they're open to interpretation. They're a little subjective. And so basically, we're going to recognize a liability. And by recognize, I'm talking about not just disclosing a liability in the notes and saying, hey, there's a potential loss here, but actually recognizing a liability on the balance sheet when two things are actually true. So one is that this event, whatever it is, a lawsuit, whatever, the chance of incurring a liability has to be deemed probable. And this is a big and, it has to be reasonably estimable. Reasonably estimable. You have to be able to come up with a reasonable figure for what this liability will be. It can't just be, oh, we have this lawsuit and we know we're going to lose, but we have absolutely no idea what the loss will be. So basically, if you can determine these two things, if you say, okay, is it probable that we're going to incur a liability? And if so, can we reasonably estimate this? Is it reasonably estimable? And if those things are true, then you recognize a liability, right? And it's going to end up in your financial statements. Now, if just maybe one of these things is true, but not the other, in that case, you would just go ahead and probably in that case you just disclose it in the notes of the financial statements. You might say, okay, it's probable that we're going to lose this lawsuit, but we can't estimate the damages. We have no idea. In that case, you would just disclose. But when it's probable and it's reasonably estimable, in that case, you would recognize a liability, which would be a contingent loss, and you would recognize that in the financial statements. Whatever the attorney, you consult them about this lawsuit, and they say, okay, yeah, it's probable that we're going to lose this lawsuit, and we think that given we lose it, we're going to have to pay $65 million. Then in the financial statements, you're going to recognize the liability for this lawsuit, even though it hasn't happened yet, because it's probable and it's reasonably estimable.